Hey everyone, welcome back to Ask a CPA, where we break down complex tax laws into straight talk for business owners, investors, and entrepreneurs. Today we're diving into one of the most talked about tax reform proposals in many years, the One Big Beautiful Bill. You gotta love that name. It's packed with some really cool changes that could seriously impact how you run your business. So let's break down the 8 biggest updates every business owner needs to know. Now, this video is just for business owners, so we're not talking about tips or overtime changes. We'll be addressing the big ticket items that will impact your business. And we've created a separate video taking a look at the changes that will impact individuals, so check out that video next. But today's video is all about business owners. So the bill was passed through the House and is currently being reviewed by the Senate, who will likely make some changes and tweaks before it's all settled. So keep that in mind, that these changes are that we're going to be discussing today are proposals. It's proposed tax law changes. They have not yet been signed into law. So before we jump into the bill, if you have a friend that's a business owner, make sure you share this video with them. This bill is full of huge tax deductions and incentives, and you don't want to miss out on them. Now, if you find this video helpful, hit that like button and make sure you are subscribed, as we'll be providing updates as this bill makes its way through the Senate. Alright, so first up, guys, is the Qualified Business Income Deduction, or the QBI deduction. It's getting a major upgrade. So under the proposed House bill, the QBI deduction would become a permanent tax deduction and increase the amount from 20 to 23%. Now, that's a big win for business owners operating as either sole proprietorships, partnerships, S corporations, or LLCs. Any kind of a flow-through entity will qualify. And here's what that means in practice. So if your business nets $100,000 after expenses, the QBI deduction alone will give you a $23,000 deduction before factoring into account your standard deductions or your itemized deductions or any available tax credits. So your adjusted gross income will drop to $77,000 right out of the gate. So this deduction is powerful. It's a straightforward 23% reduction on qualified business income, no strings attached. Congress designed it to encourage entrepreneurship, job creation, and small business growth, and it's been a massive benefit to business owners across the country since it was originally passed as part of the Tax Cuts and Jobs Act of 2017. So you guys remember the good old days when you could just write off the full cost of new equipment in the first year? Well, guess what, guys? 100% bonus depreciation is back, baby. It's a retroactive tax deduction, which will go back to January 1st, 2025. That means you can take immediate upfront deductions on big ticket purchases like vehicles, machinery, computers, and even certain improvements to commercial properties. So if you've been putting off capital investments, now might be the perfect time to pull the trigger. Now, this change is expected to be a major win for industries like automotive industries, where business owners often look to maximize their year-end tax deductions by buying automobiles closer to year-end. Now, let's take this one step further. The House bill also includes a manufacturing provision that allows for 100% write-off of manufacturing facilities. Now, this could be huge if you are a manufacturing business and need a new facility to manufacture your goods here domestically. So if you're a real estate investor, this is a golden opportunity to significantly reduce your tax burden. More than half of my business clients own some sort of investment property, whether it's residential rentals, short-term rentals, vacation homes, or commercial buildings. And that's no coincidence. Over 90% of U.S. millionaires have built their wealth through real estate, largely because of the powerful tax advantages it offers. One of the most compelling opportunities right now is the Enhanced Opportunity Zone program, originally introduced in 2017 as part of the Tax Cuts and Jobs Act. The Opportunity Zones are getting a major refresh, including expanded territory designations and the inclusion of more rural areas. So here's how it works. If you reinvest capital gains into a designated opportunity zone, you can defer taxes on those gains. And if you hold the opportunity zone investment for at least 5 years, you'll get a step up in basis of 10% in non-rural zones and 30% in rural zones. Now that means a significant portion of your original capital gain can be permanently excluded from taxation. Now, a fun fact that most people don't know, the original House version of the Tax Cuts and Jobs Act in 2017 didn't include any opportunity zone provisions. It was the Senate that pushed to include them, and it's proven to be one of the most impactful tax incentives for real estate investors. So be prepared for the Senate to make some tweaks to the House proposal. Now, a huge win for startups and tech firms is the research and development expenses are once again going to be fully deductible in the year that they are incurred. Under the current law, if your business spends money on domestic R&D costs, you can't deduct these expenses all at once. Instead, you have to spread them out over 5 years, and that is not ideal. So there's good news within this bill that's all about to change. Under the new House bill, the R&D expenses incurred between January 1st, 2025 and December 31st, 2029, you will be allowed either 3 options to deduct these costs. So the first option is to deduct the entire cost right away in the same year in which the money is spent, which will probably be the most tax advantageous option. The second option is to capitalize and amortize over the life of the research. It has to be at least 60 months or 5 years. Option 3 is to spread the cost over 10 years. Now, a quick heads up, this flexibility only applies to US-based R&D. So if your research is being done overseas, you'll still have to amortize over 15 years, just like you did before. But that's not all. This bill also gives a nice boost to R&D tax credits. More expenses now qualify for the credit, including software development and certain engineering and design work. And if you're a small business or startup, here is the best part. You can get a refundable tax credit. That means even if you are not profitable yet, you can still get cash back from the IRS for your R&D expenses. So if your business is investing in innovation, whether it's tech, product development, or engineering, this bill can make a big difference in your tax planning and your cash flow of your business. Now, the IRS is raising the de minimis safe harbor threshold, which is normally $2,500. So they're going to raise that to $5,000 per item. This means that small equipment purchases like office furniture, tablets, or computer equipment can be expensed immediately. No capitalization and depreciation is required. Now, that's great news for our bookkeeping friends and even better news for tax prep. All right, now these next couple items are exciting. Now, these are a little bit less talked about because these are items that were excluded from the House bill that are set to sunset at the end of 2025. Now, first, let's talk about the meals deduction. So the Tax Cuts and Jobs Act made all business meals 50% tax deductible. So before the Tax Cuts and Jobs Act bill, meals provided by the employer, which were on site for the benefit of the employer, were 100% tax deductible. This was great because many employers would provide lunch for trainings, or during busy times, they would keep employees from leaving during lunch, and they would provide lunch to their employees. Now, the new House bill does not address the deductibility of business meals, meaning that if the Senate does not make any adjustments, the rules will revert back to pre-Tax Cuts and Jobs Act, and the employer-provided meals will once again be 100% tax deductible. Now, let's keep our fingers crossed the Senate doesn't watch this video and catch on to this oversight, or maybe they overlooked it on purpose. I don't know. Now, and speaking of perks, entertainment expenses have been non-deductible since the 2017 Tax Cuts and Jobs Act as well. Similar to the meals deduction, entertainment is not mentioned in the House bill and will revert back to pre-Tax Cuts and Jobs Act status, making entertainment tax deductions, making them tax deductible again. So golf, sporting events, concert tickets will now be 50% tax deductible. My golf game is about to get a lot better. Now, Now, this bill is big, bold, and full of opportunities, whether you're considering equipment purchase, shifting your entity, or just wondering what this means for your tax bill. We're here to help. So if you have any questions about how the one big, beautiful tax bill affects your business, drop them in the comments down below or visit us at askacpa.co to submit your questions. Don't forget to hit that like button, subscribe, hit that bell notification so you'll never miss out on any tax savings tips. Thanks so much for watching, guys. We'll see you in the next video for Ask a CPA. Cheers.